So many of you know me. It's great to see so many great faces in the room. Kudos to UVANY. Kudos to everything that the organization has done. I think it's fantastic. I think the number of people in this room and the vibrancy of the organization and the entrepreneurial ecosystem in Upstate, this is just what it's all about. It's fun. It's great to be a part of it. For those that don't know me, a lot of familiar faces in the room. My name is Will Hoy. I'm a partner of Secrest, together with Mario Falone, who's out there somewhere. We head the firm's venture capital private equity practice. I am not why you guys are here, so I'm going to keep it short from my perspective. Great panelist with us today, so I think I'm going to turn it over to the panelists to give a brief introduction of themselves, the company that they're with currently, and some nuggets of maybe what their current capital structure looks like, which will serve as the basis for our conversation. Oh yeah.
Don't mind, I'm going to stand up. I'm Italian, I just like to use my hands and all that. My name is Modesti. I'm with Biomaxx, Inc. Tell you a little bit about Biomaxx. I'm sure that it's the least sexiest company of these four, but nonetheless, what we do is we own a couple manufacturing facilities, one in Arcade, New York, south of Buffalo, and one in Booming, Ulysses, Pennsylvania, and we manufacture essentially wood-based products. What is that? Our predominant product is wood pellets that are used for wood pellet heating and wood pellet stoves. That's our main product line. We also make a wood-based cat litter product that we make for a third-party distributor. And our third product, a little different, is we make an industrial absorbent that is used in the fracking arena, Marcellus shale. And the product is essentially mixed with the fluids and mud and what have you that comes out of the ground. Our product absorbs this and then is taken off to a landfill. So those are the products that we make. In terms of our ownership structure, we are owned by Delta Point Capital. I saw them up here earlier. Delta Point is investing out of its fourth fund. Has $60 million of invested capital. They tend to look at investments in the $6 to $9 million range, may go up to $15 million. Tend to focus on businesses in professional services, distribution, manufacturing, and also tend to look at companies with an enterprise value of $10 to $50 million. Thanks very much for editing.
I'm lazy, so I'll sit. Mike Totterman, iCardiac Technologies. We provide services to the pharmaceutical industry, specifically the clinical trial segment. The University of Rochester spin out, also hire a lot of people from RIT, from the computer sciences and technology departments. What we do with the clinical trials is process ECG data to help determine if drugs are cardiotoxic or not. Currently working with 7 of the 10 largest pharmaceutical companies. In terms of capital structure, Stonehenge was one of the early folks in. Advantage Capital, as well as a few of the Trillium funds, and then Pfizer historically was also on that cap table. And at the time of the investment, we were pre-revenue, but we had promised Stonehenge that we would quickly get to revenue.
So I'm David Chauncey, the CEO of Vnomics. We produce diagnostic and driver training systems for heavy commercial vehicles. We're a spin-out from RIT and primarily funded through angel investments, although we do have High Peaks Venture Partners as a VC investor and 2 corporations.
Thanks. My name is Tim Wilson. I'm the CEO of Arnold Magnetic Technologies. Arnold manufactures highly engineered magnetic materials and components that facilitate the electrification of systems for a greener environment. We work on really cool applications from hybrid vehicles to aircraft, etc. We employ 750 people at facilities here in the US, in Europe, and in China. Our corporate headquarters is here in Rochester, where we employ roughly 90 people. In 2004, Arnold was roughly a $90 million orphan division of a Fortune 500 company. We partnered up with a private equity group called ARTISANworks, a lending group, as well as management, and we took the company private in 2005. Did a couple of acquisitions, a couple of dividend recaps, survived 2008, 2009, where our lending group at the time actually had their lending pulled, and we had to recap the company. We continued to grow the company organically. We had an auction process in 2011 and a successful liquidity event in 2012 to another private equity group called Compass Diversified Holdings. We all stuck around. We all have a real passion for the business, and there's really some exciting growth prospects for us going forward that we will be announcing shortly.
So I think we kind of got soup to nuts, right? We got the venture side, we've got earlier stage, we got into the growth side, we've got two companies as well that are more mature than been the beneficiaries of true buyout capital. So we've got a nice group of panelists here that I'm going to ask some questions that hopefully are reasonably relevant and exciting, and if they don't like them, they can ignore them and answer the question that they wanted. So I think I'll probably just kind of kick it off, maybe Mike, with you. Tell us a little bit about, what we're here to talk about, right, is what every entrepreneur needs to know about raising some capital from investors. So give us a little bit of your story. How did it work for you? In particular, I'm interested to know about Pfizer. Why was Pfizer there? How did they play into the mix? And kind of how did you approach the market from a fundraising perspective?
Sure. I think one of the kind of biggest challenges of raising venture funding is when you need it, you can't get it. When you can easily get it, you don't need it. So how do you bridge that piece of it? So the way we were able to do it, and U of R was very helpful in this, is the technology that we licensed from the U of R had been used by the FDA in a kind of a prototype setting, and a few pharma companies had used it, or had services had been delivered to them. So we could reference essentially a set of potential users. The other thing that we also did was, before starting the company, we had fairly extensive conversations with Pfizer, which were essentially, if we were to build a company based on this set of technologies, does this solve a significant problem for you, and could we potentially partner around that? So we had essentially pre-sold Pfizer on the concept of the company. So when we went to folks like, Brian, albeit we were pre-revenue, Brian could call up Pfizer and say, Pfizer would say, yeah, this is important. We have used the technology before, it works. We are anticipating, signing a research collaboration with that. So that was the ability to say, okay, well, we don't really have revenues, but they're coming really quickly, and the large companies is vouching for us.
And did you have to bridge yourself to get there? How did you, for some of these companies, so that's referenceable accounts, I think, is a mantra that we kind of hear a lot about. Do you have a customer out there that's at least using it on a pilot basis?
So what we did, and I think there legitimately is a big opportunity to do more of this, because we do have academic institutions that have various relationships with large companies, etc. So essentially what we did is we set up shop in Alex's home. This was before Google Street View, so Pfizer couldn't figure out that it was a residence. And then we identified kind of a former colleague at Pfizer who was willing to buy some set of services from us for a legitimate purpose, so it wasn't entirely a shell game. And it was a real development program there. So, to a large degree, what we did is kept the cost structure as low as possible. We had all of our meetings, etc., at the U of R. They've got beautiful facilities. Actually, it's very fun. Like, our colleague at Pfizer originally said, "Do you really need this project?" And we're like, "Well, if we don't have a project and revenue, we're never getting any venture funding, and that won't be a lot of fun at all." So, because of the assets that we have in this community in terms of the technology transfer office, etc., you can go very, very, very far in terms of creating the illusion and reality that there is a lot of depth without necessarily having to spend huge amounts of money until you actually have to start delivering to the customers.
And so maybe I'll kick it over to Dave for a second. How did your experience kind of compare to Mike's? And in particular, I think you've accessed successfully the angel network in the region. And for entrepreneurs in the room, that because of the greater volume of angel investors and greater access to some of that capital, a lot of people are on that circuit. I think they'd be interested to hear kind of how you tap that network.
Yeah. So we had a very similar path to Mike's. We needed again, the key is to show value to the end users, to your investors. And, we did that through a partnership with Lockheed Martin that we leveraged into the Department of Defense, even though our primary market was always to be in the commercial trucking space. But we were able to get kind of a pilot customer through the Department of Defense in our partnership with Lockheed Martin. Again, that gave us the credibility. But in reaching the angel network, especially particularly the angel network here in Rochester, and I mean specifically the Rochester Angel Network, but also the other angels who happen to be here that may or may not be participating in that. I always look, what I think the key to success to pitching those people is, first of all, you need a really big market, because they're going to totally discount everything you say. So if you have a really big market and you have a story like ours was, we'll be a $100 million company with a 1% market share, everybody looks at you and says, hey, you should be able to get 1%, right? So that's a big opportunity. The second thing is, you need a key differentiator. Why are you going to win other than other people? And that really translates directly into the value that you bring to the end customer. So again, key is to have big value to the end customer, but also to know, that the angels will discount that as well. So, we save our customers typically like $250 a month per vehicle, and we charge like $50. Again, they look at it and say, well, what if you only charge $25? Well, it's still a really good value proposition to the end users. So I think those are really some of the key things. And of course, all angels and all investors look at the strength of your team. So we made sure we put together a really good board of directors down through a management team. And I would say those are the key things to really focus on.
Yeah, no, I think that makes absolute sense. And how did you how did you build that network? Were you drawing on experience from the past, or was this kind of a grassroots effort to start to build that network, build the traction for the company? I know a lot of entrepreneurs, as I say, they kind of make that circuit and they talk to a lot of people. When do you know, I'd throw this open to anybody really, all of you guys, when do you know when's the right time to come to the market and look for capital? A lot of what we've said here, and I hear you guys saying, is you can clearly be too early. But any words of wisdom there for folks out there that are thinking about raising capital?
Yeah, I'll just start since I still have the mic. It's really important to have some type of revenue, even if it's just a little bit. But what that says to the investors is that you have provided enough value to someone that they're willing to pay you for your product or service. So, I think it's really critical to focus on those end customers. Find one that is willing to pay you for what you do. And that's the right time to go get more capital. Then you can scale it from there. So.
Yeah, I would definitely agree with that. I used to be a venture capitalist in a previous life, and the problem is, on paper, you can make almost any investment, any technology look amazing. But there's a huge difference from having a piece of paper and actually delivering real value to an end customer. And the only way you can provide proximity proof of that is an end customer who has paid something for that product and service. And nowadays, the cost of putting together a prototype and building it is much less than ever before, probably with the exception of molecules and medical devices. So there is no longer the excuse of, okay, I need $5 million to roll out of bed. It was true, 10 years ago. If you didn't have $5 million, you couldn't even set up a website. Now, you got 99 cents, and you can set up a website. You got another $2. You could get access to a SQL server, a SaaS license, et cetera, et cetera. So I think it is okay that investors are saying, show me a customer, because to a large degree, in theory, if your technology is good enough, there should be some customer traction.
So if I'm going to move, now I'm going to swing the pendulum a little further to the late stage and maybe throw it over to Tim and ask him. So we've gotten a good flavor, I think, of, you know, how you get into the operational, here you go. How did you source, a little bit more about your story about the spin out, you know, about the corporate carve out. How did you source the partner that you chose or that you wound up with from the buyout side? You know, was it, how much influence did industry-specific knowledge play, you know, the story behind it?
Sure, so our situation was that our parent, which was about $1 billion company, was bought out by a Fortune $500 million company, and we became an orphan group, okay? So I remember meeting with the CEO, Mike Darnigan, out in Portland, Oregon, and he basically said, the management team came out there, and he basically says, here's the deal. This magnetic stuff is pretty interesting, but you know, we make big castings, and you can stick with us, but you're going to get no money, no attention, no financing. We're just going to suck you guys dry, or you can kind of go off on your own and take the business private. So that was a pretty clear signal that we should probably look at doing something, right? So we went through a process and we talked to a bunch of private equity folks, and it's interesting when you do that because you sort of have one foot in and one foot out, right? You're there, your fiduciary duty is to your parents. You're trying to sell the company so they get some value, but at the same time, you know you're going to be the owner of this business and have to take it to the next level. So it's actually a very, I call it one foot in, one foot out. But we navigated through that process and had a very successful outcome, you know, for both parties.
Yeah, that's fantastic. So actually, to that point, I think that's pretty interesting too on the later stage side. And maybe I throw this one up to Chris in particular is, you know, how do you manage through that process? And Tim now's been through it again, so I'll be interested even to come back to you after this. How do you manage that senior management team through that type of a liquidity process? You're kind of got two masters. There's a point at which I think the private equity buyer is going to say, okay, management team, you got to be on my side now. You know, enough of being on the sell side. It's time to come over and jump the fence. How do you manage that within the organization?
Yeah, clearly, from just speaking to my prior life, prior to Biomaxx, went through a liquidity event, and clearly is the most, I can honestly say, the most stressful event you've ever gone through. And you learn a lot, and you learn a lot about people, and certainly their true colors come through, and that's neither good nor bad, but you do learn a lot. But I think the challenge of that process, the biggest challenge I came across was keeping the corporation engaged. No matter how you keep things confidential, the rumor mill starts generating so wild thoughts, and people get distracted, and you've got to keep the liquidity event clearly concise. You've got to have an internal champion that you can trust, and that goes to something David said too, and I can't stress this enough. It starts with a good management team. A good management team will get through this process. So, but you want to stick with good partners. I think that, in my experience, was working with very good auditors, very good lawyers, folks such as Will and some of his colleagues. This will help you stay on track and get you over the goal line, because if it drags on, it's going to be detrimental to the organization. You will lose value over time because employees will undoubtedly get worried. I've seen employees leave, you try to retain them, it doesn't work. It's not that cut and dry.
Yeah, no doubt. And to anybody really on the panel as well, you know, there's a lot that type, when you're bought by private equity in particular, you know, everybody knows the private equity on the way in is going to be private equity relatively soon on the way out. So everyone, I think there's how do you manage an organization, and what do you do to communicate with your organization about who owns the company now? How do you set expectations? How do you keep morale high? You know, there's obviously a lot of misperception, I think, in the market about what private equity does and doesn't do, because only the bad stuff tends to make the press at times. So thoughts on that part of it?
Well, I don't want to monopolize here, but certainly the key is there's got to be a link between the management team and the PE firm. The prevailing thought is, you obviously throw a carrot out there, that when there's a liquidity event, the management team will prosper from that. That makes a lot of sense. Just one tweak I'll throw out with that, though, is, again, based on my experience, you can control or predict a liquidity event. So sometimes there starts and stops, sometimes an event gets pushed out. So just having that carrot out there for the management team that they're going to get something, so to speak, at the end of the rainbow, it may not be enough. And you can do things, for instance, what I've experienced or seen is a bifurcation of stock options or shares where some is based on performance, but some is based on time. So as time passes, more value inures to the benefit of the senior team that keeps engaged, keeps the retention at a high level. So there's different ways to link with the PE firm with the senior management team.
Yeah. Tim, anything from your perspective?
Yeah, from our perspective, a couple different things kind of tying in with that. So we had incentives pretty well aligned. So we had a reasonably deep option pool. Probably 25 of the top managers in the company had some level of equity, so that was good. But the other part of it is, we took the adage, we can either manage the relationship or be managed. Okay, so we really did a really good job, I think, as a team, managing the relationship. I worked with the managing director, my CFO worked for the VP. We really didn't allow the equity group. We kind of sheltered the rest of the folks from any interface with the equity group. The business was doing well, they were growing, there was no impact, and so really, the two of us at the top managed it. We didn't want well-meaning associates from the private equity group calling up the general manager of the plant asking for some data for an LP meeting, because you know what would happen, that would become priority number one. So we wanted to make sure our team was focused on running the business, getting the results, and the company was growing, so it was good. So we again, were pretty proactive. And we had great relationships. We had great relationships with Audex, and we've got a great relationship with our folks at Compass, but we work at it. And it also helps to hit your numbers.
Yeah.
Sort of
it is always easy.
the under-promise, over-deliver thing does play a part also.
Yeah, no. Happy lenders, happy invest folks. That does make life a little bit easier. So maybe I'm going to swing it back a little bit to the venture side. And, a topic that I'm sure people are always interested in is kind of the valuation discussion. And, how did you guys approach that aspect of raising capital?
It's interesting because it's like, when you look at it for the first time, you think it's a mathematical equation, and it's not. So the way we've usually looked at it, it's horrible to oversimplify to this, is, before it gets to a question of valuation, you want to find out what's the size of the check that those folks are usually writing. Is it a $100,000 check? Is it a $1 million check? Is it a $100 million check? And then, when you're raising money, generally, you got to sell somewhere between 20 to 40%, and then you got to make sure that it's not so obscenely expensive and it's no longer, interesting. So, one place to go to is, Pricewaterhouse Money Tree does a really nice report on a kind of a quarterly basis. You can slice and dice it by industry, by stage. So, I do see a lot of folks diverging from what would be considered market acceptable rates, and are upset that folks aren't willing to value their business. But it's not so much that the VC isn't willing to value the business, but if somebody else who has a similar product and good has a valuation of, let's say $6 million, and you're trying to raise money at $30 million, it's just not going to clear the market. So in some ways, it's if you use less math and more kind of bullet points, it's easier to come to terms.
And so to a degree, is it fair to say there's, to an extent, at the earlier stage, it becomes, to some degree, a market-driven exercise, certainly not a math, to your point, Matt.
Absolutely, and if you're not willing to take into account kind of the market dynamics, you'll never close.
Yep.
You'll say I think my business is worth like 20 million, and it's like, well, all the other businesses at this stage are clearing at 6 million pre,
And so maybe to Dave, as the entrepreneur there, right? I think entrepreneurs oftentimes think, oh my gosh, I don't want to suffer the dilution. And so a lot of that thinking about valuation, I think oftentimes comes back to, I don't want to suffer the dilution as the entrepreneur. How do you respond to that kind of thinking?
So it's really important to focus on the growth. I've always tried to focus on the growth in our business and where we're going, where we want to be. What does our business plan say? And you look at it from that perspective. If I get this capital and it puts me on the path to execute my business plan, and I become, a company of whatever size it is, then you look at what the math looks like at that point. That's the point to look at it. But like Mike said, the investors are very aware of the deals that are being done, and it's really very much a market-based thing. So.
And I think the other thing there too is the funny thing with venture capital is it's a bit like dating. If nobody else is interested in you, nobody else is interested in you. So the fastest way to get a VC to close is to have another VC that's interested in writing a check. So you have to, as much as it's not a mathematical exercise, it's not just a bullet point exercise either. It's how do you create this environment in which you, as legitimately as you can say, you can look at the VCs and say, I don't need any money. Now you have to have some kind of a logical rationale that says, how could you bootstrap it if you can? On top of that, you'd like to be in a situation where you got 4 or 5 VCs interested. Now you have a hope of potentially closing, but if you're just talking to one VC, they'll wait forever before they write the check.
Yeah, no, absolutely. Hey Sam, how long do we have? I was gonna maybe I know we want to throw it over to some questions as well. I'm trying to keep this.
Yeah, one more round of questions, then we'll open up to the audience for 5 minutes.
Okay, awesome. That sounds good. So this is you get to talk about what you want to talk about kind of thing. But again, that's really it. Chris, what would you say in terms of operating under a private equity owner? If there was kind of one nugget of wisdom that you would give to folks that are, in particular, are they thinking about seeking a liquidity event with a private equity buyer? If you're a management team member that says, I've got a legacy owner that I'd love to take out with private equity, kind of what, nuggets of wisdom would you convey with the mic?
I'm clearly a big fan of the private equity model. I've been through, that was my second go-around. And what I personally like about the model is it's essentially very cut and dry. It's about earnings and cash flow. I know non-PE firms could say the same thing, but it's really highlighted in a private equity firm. So kind of you cut through some of the, I'll say some of the nonsense of bigger companies that demand 5-year strat plans and all this other stuff. It's about hitting your numbers. It's about cash flow. It's about getting the organization behind you, all the managers, employees, understanding what drives cash flow, understanding the financial covenants, understanding the growth aspect. And I find that rewarding. And so far, both my experience with both PE firms has been very positive, very reasonable. And then you're not always perfectly aligned, but whoever is. And I think you learn to work together, and it's a fruitful end.
Yeah, no, that's definitely what I think everybody knows. What about you, Mike? Words of wisdom?
I'd say the same thing, frankly, about the VC models. Like everything in life, you need to understand what the counterparty is looking to achieve. So, they're looking for liquidity. They're looking for liquidity within a particular time period. You need to be sensitive to that. But the American venture capital model is just amazing. I mean, just the concept of being able to start something from near scratch if you can demonstrate that there's a solution that's got customer traction or some early customer traction, people willing to write you multi-million-dollar checks. But you also have to recognize that at that point in time, it's no longer your business. It's a partnership. You've got a financial partner, and they've written a large check to get returns. They need to get to an exit, and you need to work very hard towards delivering that. If that's not kind of thing that you want to get into, then it's better to try to bootstrap the business. So and for me, it was probably easier to get into that because I used to be on the dark side. So I know that it's the dark side. So I know how to work with it.
I'll echo a little bit of what people said, but we assembled a pretty large group of angel investors, and we raised a very large amount of angel capital, maybe one of the largest in this area for a while. But one of the key things that we did during that was to make sure that everybody was very much on the same page. We almost screened our investors, both our venture partner as well as all the angel investors, to make sure that they had basically the same set of values, the same set of long-term goals. We didn't want to find, our people are all very much in it for the long run and are long-term investors. you know, we didn't want to mix in there a short-term person in the middle because it would just kind of upset everything. So we were very careful about, you know, where we partnered with, but we also looked at what those people could bring to the party. You know, what contacts they have, what expertise they have, and we really lean on our investment group pretty heavily for advisement as we go along, and that's good for them. They you know, they're participating besides just giving you capital. So.
Yeah, the smart money point I think is a very important.
A couple things. So we've had a great experience with private equity with our first partner and our second partner. But it's really, I think the key thing is we made it really clear up front what the roles of each were. So our private equity sponsor helped us source deals. They were great at closing deals for us. We let them do that. And they managed really a lot of the capital structure, albeit we did have some say into what kind of leverage we wanted to put on the business. We ran the business. They really dialed in running the business. We did that. So between that kind of a separation was actually very successful. So that's one point. Secondly, we did a corporate carve out. Anybody who wants to do that, we were the weeds. Okay, because we were operating in a division, we really wanted nothing to do with corporate, and then when we bought the business, like, oh, now we're corporate. Well, we had no idea what we were doing. Okay, we didn't understand HR, all the legal, EH&S, treasury. There was a whole bunch of functions that we were really pretty clueless on, and that we totally underestimated. We thought it was going to cost us about $500, and it cost us a couple million. We've since kind of got that back, but it was a gross underestimation of what it takes to carve out a business. And then finally, the liquidity event, as you mentioned, those sale processes are brutal. Okay, you got to be running the business, you got to manage your investment banker, you're trying to meet up with who your prospective buyers are going to be, and number one, you got to hit your numbers, because if you're going through this process, which can take 8 months or so, 1 month of missing your numbers, that's a problem. And again, it's not over till it's over. These things can drag on. We had 2 closes that were delayed at the very end, one for a fire at our plant and one for a legal thing that came out. So again, it's never over until it's over.
No, that's great. So I think we'll maybe open it up to the floor. Anybody have questions? I've got this like little mic thing, so I'll come over here. Mr. Valentine.
Hey, Will. So Richard brought up, we've got 2 big research institutions here in Rochester, and we've got 2 companies that spun out of those institutions. So I'd like to hear how the process works and which one's best.
Great question. Did everybody heard that, I think?
The process worked really well for us. I mean, to some degree, we'd had experience. We've done another spin out of the U of R, and super helpful on a couple of different areas. One is, especially nowadays, kind of the terms under which the technology is being licensed is fairly cookie cutter, so not a lot of surprises, not extensive negotiations around it. Good payment terms in terms of when do the patents need to be paid for, et cetera. So those were all back-ended. The other thing which was also very helpful is the U of R has a kind of a policy by which folks can continue to stay in faculty positions and spend 20% of their time in outside activities. So our chief technology officer as well as our chief medical officer are both faculty who have dual appointments at iCardiac, so that was great. And then the last one is a lot of these institutions can also do sponsored research programs. So in the very beginning, to actually be able to service our Pfizer contracts, we would get a contract from Pfizer, it would be at X, we would turn around and then essentially outsource it back to the U of R and make a margin on that. So the U of R was happy because they wouldn't have been able to get a contract of that size because we did the strategic selling to Pfizer on it, and it worked out for everybody until we built our infrastructure. So we've been super happy with the relationship with the U of R, and actually continuing to talk to them about a number of other technologies that we may end up licensing in for new service lines that iCardiac.
So I'd echo that for our IT. They've been an incredible partner for us, not only helping us with the technology, but also follow-on sponsored research. We do a lot of research over there, helping us with trying to land our customers. We take them over to the labs at our IT, which are really impressive, and that helps to show that there's more than just a group of entrepreneurs working. But they also help make contacts within the community, for different service people, different investors, just a tremendous amount of support for us. So they've really been a great partner, and really, again, I mentioned before, looking for long-term investors. They're looking at it as a long-term investment with us, and they've been a great partner for us. So.
That's a great question. Anybody else? Any questions? Nothing, huh? My questions must have been awesome. This is great, thanks.
If we have no further questions, we're going to thank our panelists very much.